Three stocks, the October 2019 edition. Let's get started. What's up, everyone? My name is Ale. Welcome back to my world of stocks. As always, this monthly series is not a recommendation to buy or sell anything. It's just to teach you guys about 3 different stocks every month. And if you happen to find any of them interesting, then you can research them further and add them to your watch list. But as always, if you're enjoying the channel, then please consider hitting the like button, as that really helps support the channel, and also maybe the little notification bell. I think that helps a lot too. But with all that said, let's go ahead and get started. Now, the way that we usually do this is we take a look at one high risk stock, one medium risk, and one kind of lower risk. So let's go ahead and start with our high risk stock of the month. All right, guys, now stock number 1 is very fitting for an October kind of Halloween edition of the series, because the name of the company is Charlotte's Web. Ticker symbol is CWBHF. It's a stock that trades OTC, over the counter. Now, I have to be very careful with my choice of words for this portion of the video, because YouTube is very harsh with these type of videos. And the reason why is because the company operates in sort of the MJ industry. So I'll be using some code words for this portion of the video. Now, the reason that I like to track CW is that they're not so much of an MJ company as much as they are more of a CBD company. Now, if you're not really familiar with the industry, CBD is what is more kind of medicinal rather than THC, which gives you kind of that high effect, what some would consider kind of the negative effects. CBD is actually just very like medicinal, has a lot of medicinal properties. And so it's targeted more towards kind of a medicinal kind of market rather than a recreational one. And there's really 2 ways that you can extract CBD. So you can get it from MJ plants, which does tend to be higher in THC, and so for that reason it's actually illegal still at the federal level in the United States. But you can also get it from hemp, and from hemp it actually has a lower count of THC, and for that reason it's actually mostly legal now in the United States at the federal level after the Farm Bill was passed at the end of last year. There are some exceptions to it, but it's kind of mostly legal in the United States. And the great thing about Charlotte's Web is that their entire business is primarily focused around hemp-derived CBD. So they deal more with the legal kind of side of it, and they have less, kind of regulatory hurdles. They still definitely have a lot of hurdles, but they'll kind of should be getting lower and lower over time. Now, you may think that this limits their addressable market, as the MJ market is already worth tens of billions of dollars and is expected to grow to over $60 billion by 2024, according to Statista. So that's where most of the money is. However, you may be surprised to find that the CBD market will likely be enormous on its own, as it's already estimated to be worth over $5 billion this year, at year-over-year growth of over 700%, according to the research firm Brightfield. They also estimate that it will grow to almost $24 billion in 2023. So as a compound annual growth rate, that would be over 100% annual growth, which is astronomical for just a specific segment of the market. By the way, these figures are in billions. I just forgot to write it on the charts. Anyway, the great thing about Charlotte's Web is that they have the most market share in the entire world for hemp-derived CBD. Now, this is a bit anecdotal, but I could have sworn that I read somewhere that MJ-based CBD actually makes up the majority of the kind of CBD market rather than from hemp, but I couldn't find any reports that give exact figures for this video. But either way, hemp-derived CBD is much more legal at the federal level, so I'd have to assume that a lot of this growth is coming from there, especially when it comes to retail sales. Speaking of which, the vast majority of sales are actually coming from retail stores, as they project them to be over 60% of sales, which is a big deal for Charlotte's Web, as I'll show you in just a second. But just to put all of these numbers into a bit of context, you have to keep in mind that Charlotte's Web only did around $70 million in revenue in all of last year. That's practically nothing compared to the market size, and again, this is the hemp-derived CBD market leader that we're talking about. Anyway, the reason why retail sales could potentially be huge for CW is that they've made recent partnerships with CVS and Kroger, which are 2 of the largest retail chains in the country. In fact, before the passing of the Farm Bill last year, Charlotte's Web was only available in less than 4,000 locations, but today it's more than doubled that amount. Not to mention that close to half their sales actually come from their online website, which is a big deal because of the growth of e-commerce. And on that online website, they sell a number of different products, including oils, capsules, gummies, and even products for dogs. And because CBD products are cheaper to harvest from hemp but still sell at very high prices, Charlotte's Web is one of the few sort of MJ related companies out there with very large margins and much better profitability than the rest of the entire industry. In fact, they're actually profitable on a net income basis, which grew by 57% last year, and their EPS is expected to grow again this year by 58%. And then grow even more next year by over 200%. This helps give them one of the cheapest valuations in the industry with a forward PE ratio of only 24, which if you guys are familiar with any other MJ stocks, you would know that some of them trade much higher than that, and a lot of them don't even have PE ratios, and a lot of them have to use PS ratios, and those are like astronomical as well. Meanwhile, they continue to grow their sales thanks to the booming market, with revenue growth of 74% last year that is expected to climb even more this year by 81% and then accelerate to over 140% growth the year after. Now, they only recently went public, so there's not a lot of trading history to look at, but currently the stock sits near the midpoint of their 52-week range at about $16 a share. It was recently tanking right along with the rest of the sector, but has since recovered and is currently up by over 50% this year, so it would have been much better to get in at one of those lower prices of under $10 a share. Still, this is a stock that I love to track because I really think that the hemp-derived CBD market is one that I think could be bigger over time because it can address a much wider audience because of its low count of THC. So it's going to have less regulatory hurdles, much bigger chance that it will be sold at retail locations, which is what we're already seeing. And I think like even kind of health food stores like Whole Foods and I think Sprouts, I believe they even carry these kind of products as well. So I see more potential there for that reason because it can attract it can appeal to a bigger audience. So if I ever really did want to make a play on the MJ kind of industry, I think Charlotte's Web would be somewhere at the top of the list. Now, what does worry me a little bit is the increased competition that is really flooding into the market because they're starting to see the potential of hemp-derived CBD. So, and anytime that you see an increase in competition kind of flooding into a market, that's going to hurt your margins because you're going to want to compete more. You're going to have to, lower your prices, and it's going to hurt your margins. So that's what kind of worries me a little bit with CW. However, I think a lot of bulls would argue that they already have a very strong brand because they were kind of first to market and they're already the market share leader. So that strong brand may help them sustain some of those higher margins, but it's still kind of a concern. So it's a stock that I continue to watch, and it's one that I find very interesting. All right, guys, moving on to stock number 2. This is going to be our medium risk stock for the month. And this one is actually a very big play on the eventual rollout of 5G. And this company is called Corning, ticker symbol is GLW, and they're pretty famous for their Corning Gorilla Glass. I'm sure you guys have heard of that. If you own like an iPhone or a Samsung Galaxy or any other major kind of popular smartphone, chances are pretty high that Corning made the display for that smartphone, and it is Corning Gorilla Glass, which is a very strong display that is very difficult to scratch or crack or break. However, they have other parts of their business as well. So they make like thinner TV displays, they make anti-reflective displays. They do a lot of stuff with ceramic glasses, which is a very strong kind of material that can be used for casings, for example, and it's a good alternative to metal because it doesn't interfere with like wireless technologies like wireless charging and things like that. And it's a very strong material as well. But they also do a lot of stuff with semiconductors. They do a lot of stuff with the pharmaceutical market. They do packaging for pharmaceuticals. They even make automotive products. And on top of all that, their actual biggest business is their optical fiber business, which is a big play on telecommunications. It's big for the infrastructure and for the high speed transfer of data. So because of all that, they're a very big play on 5G, not just because of the build out of the infrastructure, but also because 5G may actually lead to the next smartphone super cycle where people are willing to upgrade their smartphones, and we could see those rates kind of climb very high. And the great thing about Corning is that they make a lot of components and pieces for smartphones, so that could lead to a bump up in their business as well. Now, taking a look at the stock, we can see that they've been a little volatile over the past 5 years. And while they are still up by over 35% over that time, the last couple of years have been relatively flat. And in the past 1 year, the stock has really struggled as they currently sit near the very bottom of their 52-week range. A big reason for this is because of macroeconomic uncertainties. See, their biggest business is their optical communication segment, and that's been really hurting lately as data center spending is down, and many companies around the world are being hesitant to spend more money on infrastructure investments given the weak Chinese and European economies and the entire trade war, with everyone also worried about a possible recession in the United States. As a result, their sales are expected to drop from growth of 12% last year to just 2% this year and 3% next year, according to Yahoo Finance. But if you're someone who thinks that the macroeconomic concerns are more of a short-term issue and that growth from 5G and the rise of data usage will eventually get this company back into high growth, then right now may prove to be a buying opportunity. Well, Corning seems to think so, as they recently detailed their new framework for growth starting in 2020 that involves compound annual growth of 6 to 8% sales and 12 to 15% EPS growth through 2023, while also distributing $8 to $10 billion to shareholders through share buybacks and increasing the dividend by at least 10% a year, which we'll talk a little bit more about in a second. To be more specific, they note that many parts of their business will either double or grow twice as fast as the market that they operate in, thanks to a variety of reasons, one of which is 5G and next generation hyperscale data centers. They also expect to grow their EPS by growing their sales, improving their margins, and buying back stock, which might actually be a smart move given that it's a bit lower at this time. And they will also continue investing $10 to $12 billion on research and development and even look into making acquisitions. All the meanwhile, their valuation is more attractive now with a forward PE ratio of around 14, while their dividend has also grown to a yield of almost 3% with a good payout ratio of 40%, 8 years of consecutive growth, and a 13% 5-year growth rate that should continue growing by double digits for the foreseeable future, according to their newest outlined plans. So if everything plays out like they think it will, then Corning could actually be a very big player on 5G that is currently trading at a discount because of macroeconomic issues. Now, if you're someone who thinks that a recession is right around the corner or that a trade deal is not going to get done with China and macroeconomic concerns are going to get worse and worse, then in my opinion, it probably doesn't make sense to be buying Corning. But if you are a bit more optimistic about the economy and you're thinking long term and you're thinking about the ramp up of 5G in the future, then Corning could actually be trading at a discount if you're really thinking long term. So I think it's a stock worth watching. It's not a stock that I own myself, but it's definitely one that I enjoy keeping a close eye on. All right, guys, finishing up here with stock number 3. This is going to be our lower risk stock for the month, and this is actually a stock that I'm heavily invested in myself. It's one of the biggest stocks that I own. And it's really been on fire lately, but even at these levels, I still think that it's pretty attractive. And that company is, of course, Disney. Ticker symbol is DIS. Now, I've talked a lot about Disney in the past, so I won't go too much in depth into their business, but they have some insanely strong brands. They have an enormous blockbuster studio that keeps pumping out huge blockbuster movies. They have theme parks and resorts all over the world that are very popular and famous, and they even have their own cruise line. And the great thing about having such a diverse business with so many moving parts that are backed by such strong brands is that the business is very complementary to itself. Whether the brands are getting you to come into the theme parks and resorts, or to go on a cruise ship, or to watch the movies or watch the TV shows, meanwhile, all of this is generating awareness back into the brands. And you're also generating huge sales from merchandising and licensing. It's just a very strong business with a very strong moat, a very strong competitive advantage with segments that are very complementary to each other. So it's a business that I've always really admired. And when I think long term, I think Disney is one of the most kind of stable investments out there for the long term because they're so incredibly hard to kind of knock off from the top. Again, because of their incredibly strong brands and their overall business that really complements itself. Now, when looking at the stock in the past 5 years, you can see that it was relatively flat up until this year. And if you were to ask me why, I would tell you that I have no idea, because I've been buying this stock for years at under $100, almost screaming to you guys that this stock was incredibly undervalued at those lower prices. Still, here we are in 2019, and the stock has finally shot up by over 20%, although they are still down about 10% from their recent highs. In any case, the most recent climb is thanks to their impending launch of Disney Plus that will only cost $7 a month and still give you access to an insane amount of content, including almost the entire Disney backlog of movies and shows, including new releases as well, and even featuring everything from Marvel, Star Wars, and even National Geographic. Altogether, in the first year, that'll be over 400 movies and 7,500 episodes, with over 25 new series, including new shows from Marvel and Star Wars, which, by the way, they recently announced a new show based on Obi-Wan Kenobi that is undoubtedly going to convince an enormous portion of the Star Wars fan base to subscribe to the new service, at least in my opinion. In the US alone, around 40% of adults tend to watch the core Star Wars movies, so imagine if even just a small kind of fraction of those people sign up for Disney Plus. That could be huge, and the low price may actually convince them just to try it out, which may lead to them getting hooked on all of the other content. Considering that there's around 330 million people in the US and 7.5 billion people around the world, and that brands from Disney, Star Wars, and Marvel are all global phenomenons, I think it's actually possible that we eventually see maybe a couple 100 million people signing up for Disney Plus, with a decent portion of them coming from just kind of Star Wars and maybe Marvel alone to enjoy the collection of movies and the new shows, which, by the way, The Mandalorian is set to have a budget similar to Game of Thrones, and all of the feedback and kind of reviews of it so far, not actual reviews, but the kind of reviews of the commercials that have been playing for Mandalorian have all been extremely positive, and everybody's getting very hyped. So I think The Mandalorian coupled with the Obi-Wan Kenobi show, those two shows I think are going to do very well and attract a lot of people to the service. For context, I think Netflix only has around 150 million subscribers right now, so Star Wars and Marvel alone could potentially make Disney Plus a close competitor to Netflix, in my opinion, in a relatively short amount of time. And that's not even considering all of the other brands and IPs from Disney that kids love and that adults will likely subscribe to for their kids, and also just because they want to enjoy a lot of nostalgia for themselves as well. And the crazy thing is that Disney is only forecasting 60 to 90 million subscribers by 2024, so in my opinion, they're very much lowballing the heck out of that number. I think they easily do over 100 million by then, if not close to doubling that amount. And I know that you may be thinking right now that I'm crazy for saying that, but again, guys, we're talking about $7 a month for one of the largest libraries of content out there that people fanatically love. Now, in all fairness, I think the number could be lower just because people may be sharing the service with each other. But either way, if Wall Street is expecting just 60 to 90 million, I think they're going to be in for a huge surprise to the upside, which can potentially raise the stock along the way, as Disney continuously reports a beat on subscriber counts every quarter and every year. Keep in mind that you can even get a bundle including Hulu and ESPN Plus for just $13 a month, which is the same as what Netflix charges, so you'd essentially get 3 services for the price of one, and that could also boost their subscriber numbers as well for each of those services. Now, I guess the only downside to all of this is that their expenses have to rise as they ramp up the platform, which they don't expect to be profitable until 2024. So in the meantime, you're seeing a higher valuation than normal, as their forward PE ratio is actually higher than their trailing PE at over 22. I know what you're thinking, that's too expensive, and I would agree that it is definitely rich, but you have to keep in mind that their sales are going to soar for a company that doesn't typically see high revenue growth, and the profitability will eventually ramp up at a later date. In 2016, their sales only grew by 6%, and in 2017, their sales actually dropped before returning to growth last year at only 8%. But in the next couple years, those figures are expected to skyrocket, with growth of 17% this year and 19% next year. So you essentially have a very well-established giant company that doesn't normally grow by huge rates, but now you're adding growth of almost 20% into the mix, and I think you're left with a stock that deserves to have a rich valuation. And all the meanwhile, you get a fantastic dividend that only yields 1.3%, but they have a very low payout ratio of only 28%, with a 5-year growth rate of almost 15% and a decade of consecutive growth to go right along with it. So as far as dividend growth stocks go, I think Disney is definitely top tier. So I think if you couple their incredibly strong brands with the newly added explosive growth and a very solid dividend that will likely get much bigger in the future, I think you're left with one heck of a foundational stock that is perfect for building a portfolio around. Now, having said that, I've mostly bought this stock at under $100, and it's currently my third largest position. So I have a huge position in Disney. So I'm very heavily exposed to it already. So there's not really a lot of reasons for me to add to my position at this time. But if I didn't own Disney stock, I think I would actually be buying the stock at this time, even at these levels. And the reason why is because Disney is really a long-term stock for me. When I'm thinking out 5 to 10 years, or to be honest with you guys, I really think Disney is probably a stock that I'm going to be holding until I retire, unless something really fundamentally changes with the company. I just can't really envision them underperforming over the long term. So no matter what happens in the short term, if the market drags it down or they go through some kind of a dip, I really just see that as buying opportunity. So it doesn't really matter to me if I buy the stock now and it were to dip. I would just kind of add to my position and lower my cost basis. It's one of those stocks that I know I'm going to be holding long term anyway, so I don't really lose sleep over it no matter what it's doing. I just know that if it gets very undervalued, I need to add to it. And at these current levels, I don't think it's undervalued at these current levels, but I think it's fairly valued in my opinion. And fairly valued is good enough for me with a company like Disney, and then just kind of adding to it if it ever does get undervalued, just kind of adding to that position. But anyway, that's just how I feel about Disney. Let me know what you guys think about any of these three stocks. Do you guys like any of these? Are you invested in any of these? And I guess that does it for the video. Make sure you hit the like button if you enjoyed the video. Thank you so much for watching. I'll catch you guys in the next one. Take care. Bye-bye.